Okay, so last class we went over recording the journal entries for issuing common stock. And we also covered treasury stock, so reacquiring previously issued shares. In this part of the chapter, we're going to kind of shift our focus from stock issuance into retained earnings first and then dividends. So why do we talk about retained earnings before we get into the discussion about dividends? What is retained earnings besides what's listed here? So it's the cumulative earnings of the company, right? When I start my company, what's my balance? What do I start with in retained earnings?
0.
0, right? I haven't earned anything yet. After my first period of operation, let's say a year, if my revenues were greater than my expenses during that year, I would have positive net income. So when we earn net income each year, it's going to increase our retained earnings, right? Because we're earning more for the company. Revenues are greater than expenses. Revenues have a credit balance, normal credit balance. So when it closes into retained earnings, we debit that revenue account and close that out into retained earnings with a credit. So they both have those credit balances, revenue and then retained earnings. When we have positive net income, it means that we earned enough in revenue to cover all of our operating and non-operating expenses during that period of time. So net income increases retained earnings. Year after year, if I have positive net income, my retained earnings balance is just going to grow and grow and grow. What are two things that are going to reduce retained earnings? So instead of retaining that amount, we're either going to distribute it out or it could be reduced because we had a bad year. So the first one up the top, what do we call that bad year? When we're operating in the red, what has happened?
Net loss.
A net loss. So when we incur a net loss, it means that we didn't earn enough revenue to cover our expenses during that particular year. Our revenue was less than our expenses during that period. Expenses have a normal debit balance. If the expenses are greater than the revenues, that means we'll have that debit balance that's greater than the credit balance, and it's going to reduce retained earnings with that debit when we close those accounts out. And when we distribute our earnings to our shareholders, what do we call that? Distribution of earnings to shareholders.
Dividends.
Dividends. Dividends also have a normal debit balance. And typically we don't even use that dividends account. We just hit it directly to retained earnings. Dividends can be either cash, so distributions that are directly proportional to the number of shares earned, or sorry, the number of shares owned by particular shareholders, or they could be stock dividends. So additional shares of stock. Regardless if it's a cash dividend or a stock dividend, they will both reduce retained earnings. What do we hope to see as the ending balance of retained earnings? A credit balance or a debit balance?
Credit.
Credit. So we hope to see an ending balance that's on the credit side, meaning that our lifetime of earnings is greater than our lifetime of losses and dividends. If we have a credit balance and retained earnings, it means we have retained earnings. If we have a debit balance and retained earnings, we have a retained deficit. In order to distribute dividends, cash or stock dividends, what do we have to have?
Retained earnings.
Yes. We need a positive retained earnings balance to distribute dividends. Without a positive retained earnings balance, we are unallowed by accounting rules to distribute dividends to our shareholders. We can't give them additional stock through stock dividends. We cannot give them cash dividends until we have a positive balance in retained earnings. So all of those startups, Tesla is a favorite one. Tesla still has a retained deficit. Tesla can't give just dividends to their shareholders until they have a positive balance. So we're going to move on to dividends. We're going to cover cash dividends first and then go into stock dividends. For cash dividends, the dates matter. Is the company legally required to provide their shareholders with dividends? Yes or no? And is it as easy as a yes or no answer?
If they decide to.
Yeah. If they declare a dividend, that's when they become legally obligated to provide a dividend. If they have no dividend declared, they're not required to give a dividend to their shareholders ever. So with cash dividends, there's 3 different dates that matter. The declaration date is the date that the board declares a dividend, a cash dividend. So on the declaration date, they're going to state how much per share they will be distributing to shareholders that are noted on the date of record, and they'll also note the payment date. On the declaration date, we're legally obligated to pay the dividend in the future. So on the date of declaration, we're going to debit retained earnings, reducing retained earnings for the dividend that we've declared, number of shares outstanding, times the dollar amount per share for the dividend. So sometimes you're going to be given the total amount of the dividend that's declared. Sometimes you'll be given the dollar amount per share, and you're going to multiply that dollar amount per share times the total number of shares outstanding. So remember, that's the number of shares issued to date minus the shares that are held in treasury stock. And at this same point in time, we're going to credit dividends payable, increasing the liability because now we have an obligation to pay this amount in dividends to our shareholders on the payment date. A few weeks after the declaration date is going to be your date of record. The date of record just tells the company who they're going to be cutting checks to. So on the date of record, if you are an owner of a share of stock in this company, you will receive a cash dividend on the payment date. If you sell your stock between the declaration date and the date of record, you're not going to receive a cash dividend on the date of payment. So you have to be an owner on the date of record in order to receive a cash dividend on the payment date. From an accounting perspective, all we care about is who we're going to be cutting checks to. It doesn't impact our journal entries. We don't journalize this. It's just telling the company who we're going to write checks to for those cash dividends. I get this question every semester. I'm waiting for it, but I haven't heard it yet because we're online. What happens if you sell your stock between the date of record and the payment date? Will you still receive that dividend? If you sell your stock after the date of record, but before the payment date, you still will receive your cash dividend because you were the owner on the date of record. For the third date, this is the date that the company actually provides the cash dividend to their shareholders. On this date, we're going to debit dividends payable. We're going to reduce the obligation for the same amount as recorded on the declaration date. And we're going to credit cash, reducing cash for the amount that we pay out to our shareholders on this date. The payment date is a few weeks after the date of record. The date of record is a few weeks after the declaration date. In your homework and on the exam, you'll definitely have to record the declaration date and the payment date. And the hardest part is coming up with and determining the number of shares outstanding, because in the problems that you're going to have in your homework, as well as on the exam, you'll have issuances of stock. You'll have treasury stock that's reacquired by the company and then sold again. And you will probably have a stock dividend in there as well. So you need to pay attention to the number of shares that are issued, reacquired, or issued in a stock dividend, because it will impact that number of shares outstanding. Questions on this? Pretty easy? Somewhat?
That makes sense.
Okay, thanks, McKenna. I'm going to go down a little bit further. And we're going to talk about preferred stock versus common stock and how preferred shareholders get paid dividends. But before we do that, in addition to having a positive balance of retained earnings, what does the company need to pay a cash dividend? Besides the board declaring it, what does the company need? They need positive retained earnings and something else in order to pay a cash dividend to shareholders. Can you buy something without cash? I mean, you have credit, but at the end of the day, can you buy something without cash? Yes or no?
Of course not.
Of course not. So if a company has a positive balance of retained earnings, but they have not enough cash to pay that dividend, can they declare cash dividend?
They wouldn't be able to, right? Because
Correct. Correct. So in order to provide a cash dividend to shareholders, we need a positive balance of retained earnings and we need enough cash on hand to do so. For cash dividends, it gets a little bit more complicated if the company has preferred shareholders as well as common stock shareholders. Preferred stock is sometimes referred to as a hybrid format of ownership. It takes on some elements of debt in that preferred shareholders will know exactly how much of a dividend they'll receive if a dividend is declared by the company. They have priority in liquidation rights over the common stock shareholders, and it typically is a little bit more of a secured ownership right than common stock shareholders. But preferred shareholders will not receive as much growth if the company expands and does well. For preferred stock, they will always receive their dividend before common stock shareholders receive anything. Preferred stock gets a little complicated when we have cumulative preferred stock. There's two types of preferred stock, cumulative preferred stock and non-cumulative preferred stock. And the difference is the treatment of dividends. So before we get into that, they're always paid out their dividends first before common stock shareholders. The amount of the dividend that they're going to receive is going to be stated as a percentage of par value or a dollar amount per share. So preferred stock dividend, and I'll write out the two calculations. Number of preferred stock shares outstanding. And if it's a percent of par value, you're going to take times the dollar amount per share par value. This down here. Times the percentage of par value.
Is the P/S par value?
Preferred stock, sorry.
Per stock.
Yes. The other calculation that you might see for preferred stock you're still going to have the number of preferred stock shares outstanding. But in this case, it's going to tell us a dollar amount per share. The dividend per share for preferred shareholders. So this is an or situation, and the preferred shareholders, when they buy the preferred stock or issue the preferred stock, they know if it's going to be a dollar amount per share, or if it's a percentage of par value. So they know exactly how much in dividends they would receive if a dividend is declared. And when I say the preferred stock dividend, I mean the annual dividend. So how much yearly they can expect if a dividend is declared. The part that common stock shareholders needs to be most concerned with is whether or not preferred shares are considered cumulative preferred stock or non-cumulative preferred stock. If the preferred stock is considered cumulative preferred stock, that means that any years that the company did not declare a dividend, as soon as a dividend is declared, preferred shareholders will receive all of the past or in arrears dividends, the past years that the dividend was not paid, plus the current year dividend before the common stock shareholders receive a dividend. So let's say that this company has been in operation for 20 years and they've never declared a dividend. They have preferred stock that's cumulative. They would have to pay those 20 years worth of preferred stock annual dividends plus the current year dividend before common stock shareholders receive any dividend from the company. It could be a significant amount if the company has past dividends or in arrears dividends. All of that's in the footnotes, all of it's declared in the financial statements. So companies, if you're purchasing common stock of the company, you want to look at that information because it will impact the dividends and whether or not the company actually declares a cash dividend. And they legally could just declare a dividend that's equal to the amount that they need to pay their preferred shareholders. They have the right to do that. If the preferred stock is non-cumulative and a dividend wasn't declared in a past year, it doesn't matter. If a dividend's declared in the current year, non-cumulative preferred stockholders will only receive their current year dividend. So we're going to focus on cumulative preferred stock and kind of look at how it's going to impact common stock and how much of a dividend common stock shareholders will actually receive. Superb Manufacturing, Inc. reported the following: preferred stock cumulative, $1 par, 6%, 90,000 shares issued. Common stock, 30 cents par value, 9,130,000 shares issued. So notice that they have a lot fewer preferred shareholders than they do common stock shareholders. That's pretty normal. The par values are different. For common stock shareholders, we could care less about par value when it comes to dividends. It means nothing. And really, honestly, the 9,130,000 shares issued of common stock doesn't mean much either to us at this point. Superb Manufacturing has paid all preferred dividends through 2016. Compute the total amount of dividends to both preferred and common stock shareholders for 2019 and 2020. If total dividends are 90,000 in 2019 and 270,000 in 2020. So we're going to start with 2019. Which situation do we have? Did they give us a dollar amount per share or a percentage of par value to calculate the annual dividend?
Percentage of par.
Percentage of par, correct. So preferred stock annual dividend. How many shares are outstanding for preferred stock?
You have a question, Professor?
Yes.
In the chat, I believe someone texted you something.
Oh, thank you. When doing the hard test with the problem, usually tell us if it's, yes, it would have to tell you if it's cumulative or non-cumulative. For non-cumulative, it just will, it likely will not say anything, but for cumulative, it will say cumulative. And there would be no way for you to figure it out on your own, so that's why. For preferred stock's annual dividend, how many shares of preferred stock do we have outstanding?
90,000.
Correct. 90,000 shares of preferred stock. And I'm writing preferred stock so you know that it's only the preferred stock shares that we care about. And they gave us a dollar amount per share for par value, which was a dollar per share. Par value. And their dividend is based on a percentage of par value, 6% of par value. So essentially, it's 6 cents per share. Dollar per share times 6% of par. So annually, how much is the preferred stock dividend for this company?
5,400.
Correct. Per year. For the 2919 preferred stock dividend, what do we need to be concerned about? They haven't paid dividends since 2016. They have not declared or paid dividends to their shareholders since 2016. So the first thing that we have to do is include
2017 and 2018.
yes, the dividends in arrears. So those dividends, those years that we passed on the dividend, we didn't declare a dividend or pay a dividend to our shareholders. So 2017, we owe our preferred shareholders how much?
Is it like the same as 2019, 5,400?
Correct. It's always the same amount, 5,400. As long as they have the same number of shares, preferred stock outstanding, which they typically do, it's always the same amount each year. 2018, we passed on a dividend, meaning we didn't pay the dividend in 2018. $5,400. And 2019 is not a dividend in arrear, but it's the current year dividend. $5,400. So in total, for 2019, how much are we going to pay out in dividends to my preferred shareholders or to their preferred shareholders?
16,200.
$16,200. For common stock, you take your total dividend that's declared for 2019, which was $90,000. We subtract the preferred stock dividend total amount. So the total preferred stock dividend for 2019. $16,200 is the preferred shareholders cut. So what amount are we going to have left over for my common stock shareholders? $73,800
800.
is the common stock dividend. No worries, Alex. So of that 90,000, common stock shareholders got a large dollar amount, correct? $73,800. But that $73,800 is being split between 9,130,000 shares. So on a per share basis, it's a very small amount.
So we divide that.
Yeah, if you want to figure out the common stocks dollar amount per share, you would just take the total common stock
9 million. Yes.
divided by the number of shares outstanding. It's a small amount. Dividends to common stock shareholders is typically a small amount because common stock shareholders gain more from the growth of the company when the company is being successful. So it's better that the company is reinvesting their earnings back into the company versus distributing them out to shareholders. In 2019, they had 2 years in arrears for dividends. So preferred shareholders got 3 years worth of dividends in 2019 because they missed out on 2 years of dividends in the past. If this was non-cumulative preferred stock, you would only see this one amount, $5,400, the annual amount. Do you want to try to do 2020 on your own? Figure out the preferred stock dividend and then the common stock dividend. Okay, so 2020 is a little bit easier than 2019, correct?
Yes.
Why is 2020 easier than 2019?
Because in 2019 we paid for 2018 and 2017 as well.
Correct.
Yes.
2020, they don't have any dividends in arrears. They're already paid up through all of the past dividends. So preferred stock only is going to receive their current year preferred stock dividend. So the 2020 dividend for preferred shareholders is going to be equal to the annual preferred stock dividend, $5,400. For common stock shareholders, they're going to receive a much larger piece of that pie this year. So
But isn't it 270,000?
what was that?
But isn't it 270,000?
Yes. 270.
So wouldn't you put 270 times 1 times 6%?
No. So 90,000 shares is what you're multiplying times the dollar amount per par value per share times the percentage. The amount of the dividend that's declared each year doesn't have any impact on preferred shareholders other than if they have enough to pay all of the dividends and arrears plus the current year dividend. It doesn't impact the amount that they receive. For the total dividend declared, we're going to take the 270,000, subtract out the preferred shareholders dividend for 2020 of 5,400 to back into
264,600.
correct $264,600 is how much the preferred shareholders, or I'm sorry, the common stock shareholders will receive in 2020. Much larger piece of the pie because we're still dividing it by the 9,130,000 shares that were issued for common stock. So on a per share basis, they receive more in 2020. Questions? Is this somewhat easy?
I'm kind of confused why we didn't do like the per share annual dividend, like 270,000. I know you explained it, but can you explain it a little bit further?
So 270,000 is the total dividend that's declared by the company in 2020. Preferred shareholders and their annual dividend is always based on the number of shares of preferred stock, 90,000 preferred stock shares, times the par value per share, which doesn't change, it's still $1 per share, times the 6% of par value, which also does not change. So the only thing that's potentially that could change in a year is this, the number of shares of preferred stock. If they issued additional shares of preferred stock, or if they reacquired shares of preferred stock between the years, then it could change the total amount of the preferred stock dividend. But if they had no change in the number of shares of preferred stock outstanding, it wouldn't change it.
Okay, gotcha. I think I was just thinking that the 270,000 was shares of preferred stock. That's what got me.
Got it. Yeah. Nope. The $90,000 had nothing to do with the 90,000 shares of preferred stock.
That makes more sense.
Last year. Sorry.
I got that too.
Yeah, sorry.
I made the same mistake.
This is the first semester that I've ever noticed it was the same number, so I'll probably switch it going forward. So thanks for that.
No, actually, it was good.
Yeah, I was like, what?
Thank you for asking a question. Okay, do you guys have any questions on this other than that? Do you want to take a quick break and then we'll move into stock dividends? And I think we're going to have time to go over a homework problem that's
Sure.
tricky. Okay, so let's take 10 minutes and then come back by 11:13.
Perfect.
I'm going to try to copy over something.
All right.
Okay, so we talked about cash dividends just now, and the last part that I want to cover in this chapter, besides the homework problem we're going to go over, is stock dividends. So stock dividends are proportional distributions of stock to shareholders. And if we don't have enough excess cash on hand, it's a good way of kind of saying, thank you for believing in our company. We want to give you something as a kind of thank you for being an investor in our company. So here's a proportional stock dividend. So instead of cash, you actually receive additional shares of stock without even purchasing them. For stock dividends, it's good for the shareholder because at the time of the distribution of the stock dividend, your overall portfolio will actually be valued at the same amount. But over time, if you own more shares and the stock price rises, which typically does, especially over the long term, then that means you're going to increase the value of your investment over time without even putting in additional capital towards it. So when we distribute stock dividends, it does have an increase in the stock account. So common stock or preferred stock, if it's preferred shares that we're distributing, it's going to be impacted. Potentially additional paid-in capital may be impacted by a stock dividend. And at that same point, because it is a dividend, it's a distribution of earnings, it's going to reduce retained earnings. So it comes out of one part of stockholders' equity and it's put into a different part of stockholders' equity. It moves from retained earnings into paid-in capital. So the net impact on equity is actually unchanged because one part of stockholders' equity is increased, one part is decreased. The nice thing about stock dividends is we can conserve our cash. We don't have to pay any cash for a stock dividend. The other nice thing about a stock dividend is that because we're increasing the number of shares issued and outstanding, it actually is going to decrease the price that the shares are actually trading for in the marketplace proportionately. So if my shares are trading at $100 per share and I distribute an additional twice the amount of shares that we currently have outstanding, or equal to the number of shares outstanding, it's going to divide it in half. So the price would drop from $100 per share to $50 per share. When you have that dramatic drop in the share price, more people can afford to purchase shares of stock from your company. So it opens the market up to further trading of your stock. And typically what you see is they'll issue a stock dividend or do a stock split. It reduces the value of the stock at that point. But in the total portfolio of the company, or not the company, but the investors, it's actually the same value. And over time, if they own more shares, the value is going to increase as the stock price increases. The other thing that happens with a stock dividend is because we're increasing the number of shares, it typically is going to decrease the par value per share that we see. For stock dividends.
Sorry, I have a question.
Yeah.
So if you decrease the number of shareholders, you also decrease?
It's not going to decrease the number of shareholders. It keeps the shareholders the same. It just distributes shares to them. So if I own 2 shares and they do a 50% stock dividend, I would receive an additional 1 share. So I would own 3 shares now instead of 2.
Yes. Does that increase the value though?
It
or
does. Not at the point of the dividend, but after the stock actually changes the value. So on the date of the dividend, on the date the dividend is distributed, their portfolio is the same. Those 3 shares are worth what those 2 shares were. But over time, as the stock price increases on a per share basis, their portfolio grows.
Okay. Yeah.
Personally, if I do receive dividends, I want them to be reinvested. I would rather have stock dividends than cash dividends. Cash dividends are usually a very small amount and it's really not worth it to the investor to receive them. Stock dividends over time have a bigger impact on the investor. The big thing, what was that?
I don't know, man. I don't know if it was just me, but it sounded like the mic was very like crazy right now. I just wanted to like, hey, slow down. Like,
okay right now?
No, you're good now, but like before, it was like like, you know. Like,
Thank you. Sorry.
yeah. All right, no, I'm.
I will hold it now. Okay. The big key thing for a stock dividend is the size of the stock dividend. GAAP states that if the dividend that's declared is considered a small stock dividend, that means that 25% or less of the outstanding shares are being distributed. We're going to record that stock dividend at fair market value. Of the stock. So how much the stock is trading at on that date. So if I'm Apple and my shares are trading at $150 per share, I have to, if I declare a small stock dividend, I'm going to take a hit to my retained earnings and reduce my retained earnings balance at market price per share. When a small stock dividend is declared, we're going to debit retained earnings, reducing retained earnings. And the calculation that we're going to use is the number of shares outstanding times the percentage of the stock dividend. So right here, when we're multiplying, we're trying to figure out the number of new shares issued from this stock dividend. And it's going to be valued at the fair market value per share. How much the shares were trading at the date of issuance of that small stock dividend. At the same time, we're going to credit common stock for the number of shares outstanding times the percentage of the stock dividend times the par value per share, because only par value is recorded in the common stock account. Because we're issuing the small stock dividend at the market price, we're going to calculate that difference on a per share basis. So fair market value per share minus par value per share. And it's going to be recorded in additional paid-in capital, APIC, or paid-in capital in excess of par. So if I have 100,000 shares issued and outstanding, and I declare 25,000 share stock dividend, it's considered a small stock dividend, and it have to be recorded at market value. If a company distributes greater than 25% of the outstanding shares, it's considered a large stock dividend. The key difference is that it's recorded at par value. So I don't care what the market price is per share if I distribute a large stock dividend. So GAAP is essentially incentivizing companies to give out large stock dividends if they're going to do a stock dividend, because the market price per share is usually substantially higher than the par value per share. So if we're distributing a large stock dividend, even though the number of shares is substantially higher that we're going to distribute over a small stock dividend, it's usually going to have less of an impact to retained earnings, because instead of recording it at the market price per share, it's recorded at par value per share. So we're going to debit retained earnings, calculating the number of new shares again by taking the number of shares outstanding times the percentage of the stock dividend. And this time we're going to record it times par value per share. And in that case, we'll only have a credit to common stock because common stock is recorded at par value. There won't be a difference that needs to be recorded to additional paid-in capital. questions before we go into a problem?
Still writing some of this stuff down, but I'm kind of trying to get it, So companies do this when, like, if they have a share of like $100 per share and it's not like selling as much, that's when they're gonna want to bring it down so like others can, buy in essentially.
Correct. Usually, if their stock price gets historically high, they'll do a stock dividend or a stock split. A stock split, you don't have any entry to record, but it has the same impact. So they could do a stock split, 10 for 1 for every 1 share you have, you get 10 shares. So your stock price would reduce by 1/10 or to 1/10 of the price that it currently is at. With a stock dividend, it's the same kind of impact on the stock price.
Yeah, I get the idea. I think when we see the problem, I think I'm gonna get a better understanding.
It'll make a lot more sense.
Yeah. Sounds good.
And basically, it's still providing incentive to your investors without having any impact on cash. That's the big part. Do you guys need to see this for a little bit longer?
I've got it.
Okay. What we're going to do is a comprehensive problem because I know that it is a test problem or similar test problem. And then I also know that you'll have it in your homework. So I want to practice it with you. So in general, stockholders equity is kind of confusing just because you don't use it on a daily basis. But stockholders equity, this chapter isn't as difficult as the previous 3 chapters that we've been going through, correct?
Yeah, I think liabilities is the hardest one out of all 3 of assets and stuff.
Yeah, that's correct. You're right. So we're going to do problem 1079A. If you have your textbook up, it's on page 581. The setup is what it looks like in the textbook, but it's not as pretty. Sorry, it doesn't copy as easily. So Jubilee Jewelry Company reported the following summarized balance sheet at December 31st, 2018. So this is the opening balance sheet, and there's some information that you're going to want. During 2019, Jubilee completed these transactions that affected stockholders' equity. So these are the journal entries we're going to record. But before we even start on that, we're going to keep track of a few things. So the common stock account in shares, we're going to keep track of. So number of shares. Treasury stock, you also want to keep track of shares as well as dollars. So we're going to do 2. Before we record any of the journal entries for 2019, let's start with what we know. For stockholders' equity, they gave us, sorry, this is supposed to say preferred stock, 70 cents cumulative preferred stock, $5 par, 800 shares issued. So 4,000 is the balance for preferred stock. Common stock, they have $6 par value, 6,700 shares issued. So for common stock, we need that 6,700 shares in the beginning balance. There's no treasury stock at this point. So the beginning balance for treasury stock and shares would be 0 shares and $0 in that treasury stock account.
Professor, where does it say the 6,700?
Right here.
Oh, gotcha. Thank you.
Yeah, it's in the balance sheet. Let's see. Okay. First date is February 13th. Issued 5,400 shares of common stock for $9 per share. Before we even get started on recording that $9 per share is the market price, right?
Yes.
And what are we going to be comparing that market price to?
The par value.
Par value, correct. So $9 per share. We're comparing it to the par value, which was $6 per share. So how much above par did we issue our common stock for?
3 shares.
$3 per share.
Not $3 per share.
Correct. Okay, do you want to try to record this one? You'll have 1 debit and 2 credits. Try to record it.
I don't know if I'm just ahead of the game, but
What was
I
that?
don't know if I'm ahead of the game, but you know when we wrote down like, yeah, I'm gonna write down right now. I'm gonna write down.
Okay.
Like it was number of shares outstanding times the percentage of the stock dividend. That's not
Oh,
what
we're
this one's
not
asking,
doing
right? That's like a
No.
okay. That's why I'm so confused. I'm like, wait, I'm not. Aren't I supposed to have something here?
No.
All right, never mind.
This is just the recording of the issuance. So that's probably sorry about that. On February 13, you issued 5,400 shares of common stock for $9 per share. What are we going to debit when we issue common stock?
Cash.
Cash. So we're receiving cash, right? It's the whole reason why we sell stock is to increase capital, to have cash available. And how much cash do I receive? 5,400 shares
Times $9.
correct, $9 per share.
I was not sure about that, but I was thinking it.
Yep.
48,600.
Is it 48,600? Sorry,
Correct.
my bad. I mean, cut you off.
So the shareholders, when you issue the shares, have to pay market price. The market was trading at $9 per share for your stock. So that's why we received $48,600 on that date. So what happens to my common stock account?
We credit it.
We're going to credit it. So I'm going to add in those additional shares. Now we have additional shares outstanding, issued and outstanding. So we're going to credit 2 accounts, additional paid in capital, increasing additional paid in capital, and we're going to credit common stock, increasing common stock.
For 12,100.
So common stock is going to be increased by 5,400 shares times par value per share, which is $6 per share.
$32,400.
So 32,400, correct. The amount issued above par value, or how much we collected above par value, is going to be recorded in additional paid in capital. So 5,400 shares were issued times $3 per share above par. And that is the difference that we need, which is $16,200. So when we issue common stock, it increases the number of shares issued, which is what we show in our common stock account. After we issue those shares, how many shares do we have issued?
48,600.
So 6,700 plus 5,400, 12,100, is that correct?
Yes.
12,100 shares issued. You want to keep track of that as you go through it. Questions on this one?
No, no questions.
Okay. Is it coming back to you a little bit?
Yeah, I was just lost in my own confusion. I was just too ahead of myself, I think.
Yeah, you're thinking a few steps ahead. For June 7th, they declared the regular cash dividend on preferred stock. So we need to go up to the information above for preferred stock. And like I said, I'm missing the information. I'm missing that title, sorry. Preferred stock is 70 cents cumulative preferred stock, $5 par, 800 shares issued. So 70 cents is the dividend per share amount. Preferred stock dividend, we'll calculate it here, is going to be equal to the dollar amount per share times the number of preferred stock shares outstanding. So 70 cents per share is the amount of the dividend times 800 preferred stock shares outstanding. So the regular stock dividend, or sorry, cash dividend that preferred shareholders will receive is how much?
560.
560. So this is the declaration date. On the date of declaration, we're going to debit retained earnings reducing retained earnings by $560. And we're going to credit which account?
Dividends payable.
Dividends payable, correct. Increasing our liability by 560. For June 24th, which is the next date, you paid the cash dividend. No calculations needed because we already have the amount.
So we debit the dividends payable. And
Correct. We're going to debit dividends payable. It's no longer going to be a liability. It's no longer owed, right? We're going to reduce dividends payable for 560, and we're going to credit cash for $560. Paying out that dividend that was owed. Were those two dates too difficult?
No, I would not. I would not.
Those ones are pretty easy.
Yeah, pretty easy. That's what I was hoping you'd say. So We're going to move on to August 9th. August 9th is a little bit more complicated, and this is going to get into the new part. Declared and distributed a 20% stock dividend on the common stock. Market price of the common stock was $12 per share on this date. So that 20% stock dividend is considered a small stock dividend or a large stock dividend?
Small.
Small stock dividend. So we're going to record it at market price. So that $12 per share is relevant. This journal entry is going to impact journal entries later. So it's important that you realize that when we declare a stock dividend, we pay out a stock dividend, we're going to have additional shares issued. So you're going to increase the number of shares over here in our common stock account. So this is a small stock dividend. We're going to take, I guess we'll write the journal entry first. We're going to have a debit and 2 credits on this date. On August 9th, we're going to debit retained earnings. I'm actually going to abbreviate it if you guys don't mind. We're going to reduce retained earnings, and now we're going to do the calculation. What's the first number that we need?
Outstanding shares.
Correct. Number of shares outstanding at the date of distribution, this date that we declare and distribute the stock dividend. How many shares were outstanding for common stock?
Is it the 5,400 or is that like a separate transaction?
No, this is why I'm very happy that you said the 5,400.
The 3 shares?
It's the 12,100 shares. So remember that outstanding is issued shares minus treasury stock shares. Currently have 0 shares in our treasury stock. But the number of issued shares at August 9th is equal to 12,100 shares. The beginning balance, we had 6,700 shares issued. When we started the period, we issued an additional 5,400 shares. So currently we have 12,100 shares of common stock outstanding.
So the current running balance of common stock is the answer.
Correct. 12,100 shares outstanding. Minus the treasury stock shares if you had any. But in this case, it's 0. Times the 20% stock dividend times market price per share on the date of declaration and distribution, $12 per share.
Is it 29,040?
I'm not correct. That is the correct total amount, but before I get there, I just want to write one other thing.
Okay.
Take the time and do this. And I can write it off to the side if it's easier. 12,100 shares outstanding times 20% stock dividend. And this is going to give me the number of newly issued shares. So 12,100 shares times 20%. How many additional shares do we have? How many additional shares?
2420 or 2420.
I believe that's correct. Yes. Just want to double check really fast. 12,000. Sorry, 2,420. Is that right?
Yes.
Okay. Shares. Before you even go further, I want you to add them over here. So on August 9th, we had a stock dividend. We distributed an additional 2,420 shares. So what happens is we increase the number of shares issued. And now our new balance for the number of shares issued, 14,520. Does that make sense?
Yes. On my end.
You need that. You have to know how many shares are issued and outstanding as you go forward, especially if you look further down, December 31st, you declare a dividend for common stock. They don't tell you the total amount of the dividend, they tell you the per share amount. So you're going to need the information with the shares above. For the rest of this journal entry, we're going to record part of it in additional paid-in capital, increasing additional paid-in capital. Part of it's going to be recorded in common stock, increasing common stock. Same calculation. For common stock, it's 12,100 shares outstanding times the 20% stock dividend. I'm just being consistent with what's above, times par value per share, which is $6 per share. And we're going to credit common stock for how much?
14,520.
14,520, yeah. And additional paid-in capital is going to be for the difference, which is the same amount this time, only because par value is half of the market price at the date of issuance. So 12,100 shares outstanding times 20% stock dividend times $6 per share above par value.
But that's never the case though when the difference is equal to half of the common stock.
Yeah, it's usually par value is not such a high number. So it is kind of unusual that it's just the same amounts. And it only has to do with the fact that it's just the difference, and the difference happens to be 6, the same as par. Students don't usually have a difficult time with this particular journal entry. You don't usually have a difficult time with the remaining entries, but the dollar amount that you're calculating is usually the part that gets messed up further down because of these shares that you forget about. For October 26th, reacquired 600 shares of common stock as treasury stock, paying $14 per share. Remember, with treasury stock, we ignore par value. We don't care about par value. This is going to be our cost basis, right? What comes into and out of the treasury stock for these 600 shares will be at par value cost basis, $14 per share. So we reacquired 600 shares of common stock as treasury stock. We're going to have one debit and one credit at this point. What will our debit be to?
Treasury stock.
Correct. We're going to debit treasury stock, increasing that contra equity account, and 600 shares are reacquired times $14 per share. How much do we pay for that treasury stock?
8,400.
Correct, $8,400. And how did I buy that stock? How do you buy anything? Pretty much.
Cash.
Cash, yeah. So we're going to credit cash, reducing cash for the same amount, 8,400. In my treasury stock account, we started with 0 shares. Now we have 600 shares. In dollar terms, we have 8,400. And the part that you care about for the dollars is the cost basis, which is $14 per share. So if I was to give out a dividend today, how many shares outstanding do we have after reacquiring those treasury stock shares?
What?
How many shares outstanding do we have after reacquiring those treasury stock shares?
Or would we add the 8,400 to 14,520, making it 22,920? Or
Maybe 6,100.
So we're going to subtract. That's why I wanted to ask that. Number of shares outstanding.
oh, because we acquired some back. That's why. Oh,
Correct. Yeah. So this is on 10/26. To calculate the number of shares outstanding on this date, we would take number issued, which is 14,520
Okay.
right here. The balance of my common stock, the number of shares issued, minus number of shares in treasury stock. Because they're no longer outstanding in my shareholders' hands at this point in time. We are owning these shares right now. So the number of shares outstanding decreases from 14,520 to what?
13,920.
13,920. So remember, treasury stocks, that contra equity account, so these two net against. You have a credit balance and a debit balance. They net against each other. For November 20th,
I have a question. Why
Yeah.
is the 14,520? How are those still outstanding if on August 9th we distributed money for that?
So, okay, on August 9th, what we did was we didn't distribute cash, we distributed additional shares. So we issued additional shares to our shareholders and gave them an additional 20% of shares. So if I own 10 shares on that date, I would now own 2 additional shares. So after the declaration and distribution of those shares, I would own 12 shares of stock, not 10.
Oh, okay.
Yes, so it increased the number of shares issued and outstanding at that point. Since we had 0 shares in the treasury stock until 10/26, we still would consider 14,520 shares outstanding. After 10/26, when we reacquired 600 shares, it was reduced.
Okay, makes sense.
Yeah.
So you basically take the ending balance of shares issued minus the
Correct.
count. Yeah.
Correct. It's always going to be the running balance. That's why we're going over it right now. November 20th, sold 300 shares of the treasury stock for $18 per share. So the market price on the date of the sale, change the wording, was $18 per share. And I'm comparing that to what value per share?
14.
Correct. The cost basis per share. So the difference is always charged to additional paid-in capital. In this case, we sold the stock for $4 above cost. So we're going to increase additional paid-in capital by $4 per share. The difference.
Professor, where did you get the 14 for the cost basis?
How much we reacquired the shares for.
Oh, the one above. Gotcha.
The one above, yeah. So whatever goes into and out of the treasury stock account is always at how much we paid for that treasury stock.
Also, can you scroll up, please? The bottom half I think, is getting cut off.
Yes, is that better?
Thank you.
You're welcome. So on November 20th, we're going to debit which account? What are we going to receive when we sell something?
Cash.
Cash. So debit cash, increasing cash, and how many shares do we sell?
Do we take the
300. Oh, never.
Yep, 300 shares were sold. At what price?
18.
$18 per share, market price.
$5,400.
Correct, 5,400. That is odd that it's the exact same number as the other example. 5,400. We're going to credit additional paid-in capital, right? Increasing additional paid-in capital, and we're going to credit common stock. Sorry, no, we're not. We're going to credit which account? Not
Treasury.
common stock.
Treasury stock.
Treasury stock, yes. Decreasing treasury stock. So how many shares are we going to decrease from treasury stock? How many shares are we going to take out of treasury stock? $300 shares sold, right? Times what amount?
14?
14. It's okay. I wanted you guys to struggle a little bit with that one. The reason why I'm showing you the calculation is because your brain sometimes just wants to look at the balance of your treasury stock account and take the total amount.
thousand a day.
but we only sold 300 shares, so we still have a balance of 300 shares, right? Left over in treasury stock. We still have and are holding on to 300 shares. The cost basis is per share is what we're going to use to reduce the treasury stock account. 300 shares sold times $14 per share. Treasury stock is going to be credited for $4,200.
200.
On November 20th. Still at $14 per share. And just to make sure that we have the correct balance in this account, 8,400 minus 4,200 equals 4,000.
Oh no.
Sorry. Equals 4,200. When I take 4,200 divided by 300 shares, which is the number of shares in that, does it equal $14 per share?
Yes.
Yes. So you know it's the correct balance. You know that you credited the account for the correct value because you still have an additional 300 shares in treasury stock worth $14 per share. For additional paid in capital is $300 per share, or sorry, 300 shares sold times $4 per share above cost. So we're going to credit additional paid in capital for
1,200.
1,200, correct. And we know that that one would either be debited or credited depending if we sold it for more or less. Take the time to do this last step over here. After this transaction on 11/20, how many shares are outstanding now? So
13,920.
we still have, sorry, Alex, wait 1 second. 14,520 shares are still issued. That didn't change. But now the balance of our treasury stock only holds 300 shares. So after we after we sold some of those reacquired shares, our balance in treasury stock, number of outstanding shares becomes what? 14,220
220.
shares. Without those T accounts showing the shares, you would have to go back through every single journal entry and count out the shares. And it's likely that you'll make a miscount or forget something. For December 31st, that's the last journal entry. Declared cash dividend. And this is only for common stock shareholders. So declared a cash dividend of 25 cents per share on the outstanding common stock. Dividends will be paid in January of 2020. So on the declaration date, what are we going to debit?
Retained earnings?
Correct. So we're going to debit retained earnings, reducing retained earnings, and we're going to take the number of shares outstanding, 14,220 shares were outstanding as of December 31st. Times 25 cents per share, which is the dividend value per share. So we declare a dividend of $3,555. And on December 31st, when we declare the dividend, we're going to credit,
Dividends payable.
correct, dividends payable. Increasing the obligation or liability because we owe our shareholders $3,555 in that will pay out in January. Questions?
Yeah, when you subtracted the 300 shares, are you supposed to add it to the common stock T chart?
No,
Don't
because
do that. Don't do that, right?
you do not do that. In the common stock account, you only show the number of shares issued. So it's a running cumulative total.
Okay.
If you had retired some shares that were previously issued, then you would reduce that common stock account, but typically you don't retire shares. So common stock is just going to be a number that keeps growing.
Okay. That makes sense.
The issued shares are cumulative, running total.
Okay.
Treasury stock is where you'll see the increase at one period, decrease, and it's going to kind of change depending on as they purchase and reacquire those shares and then sell them. Questions? I'm not going to do part 2, but you will have to do it. So the second part is prepare the company's stockholders' equity section of the balance sheet as of December 31st. And then they gave you net income so you can calculate retained earnings balance. For this particular problem, I would recommend just using T accounts for all of your stockholders' equity accounts that they gave you. Preferred stock doesn't change because nothing impacted preferred stock, but paid in capital in excess of par and the common stock account, as well as retained earnings, are impacted by several journal entries. So I will end the recording.